The Money Show.
Personal Finance with Warren Ingram.
So, Warren Ingram, when it comes to thinking about retirement one day, for some it's closer than others, how do we think about the way in which we treat our money? There's this whole idea that when you're approaching retirement at 900 kilometers an hour, it's time to start thinking about restructuring your portfolio, which is a big word for going to your financial advisor and saying, dude, I'm about to retire, what must I do? Please explain.
And very often, Bruce, advisors will say things like, well, you're getting to retirement. It's time to, think about risk very differently. You can't take too much risk now because, when you turn, let's say 65, there's no more time for your money to recover if you're, investing in and the stock market goes down. And I must say, for me, that's probably, as close to criminal as you can get in the advice space, because, longevity is a thing. It's not a trend, and it's not it's not kind of something that happens on social media. Longevity is a reality for all of us. And, if you hit 65 in just decent health, there's a really good chance you're living for another 30 years. And de-risking your portfolio, going from, let's say, 2/3 in shares, which is, a typical retirement portfolio, down to, 1/3 in shares. All that's really going to do is pretty much guarantee that you're not going to get the capital growth you need. Your money won't protect itself against a loss of buying power. In other words, around inflation. And then you kind of get into your let's say mid 80s with really compromised buying power and no real ability to protect yourself against an inflation spike. And I don't need to tell anybody listening to this that inflation is real, and it does go in cycles, but it's going to come back again and again and again. And the only assets that protect you against inflation are things like shares, things like property companies, growth assets, and those come with volatility. And so de-risking yourself to give yourself certainty, what you've bought is certainty that your money is going to lose its buying power. And it's such catastrophic advice, but unfortunately often repeated and often followed, which is, I think, really tragic.
I've told you, I think, this story before. I remember 20 years ago going to an unnamed private bank to interview a senior executive there. They were talking about how they advised their clients. And this was a private bank with lots of private money. And they said, by the time you get to 55, you've got to be out of the stock market and you've got to be in cash and you go into the money market, and therefore you get a good, stable return. And, in the sort of 12 years, the 10 years, I suppose, from 2012 or 2010 to about 2020, that, you would have done quite well with that sort of strategy, because the JSE went, practically nowhere, but you couldn't have forecast that was what was going to happen. And you certainly can't forecast the future. I wonder, just, and I can't go back to that time. I don't remember exactly what was going on in the markets, but I wonder whether that paid off for that particular private bank's clients in those days, or whether it turned to be a very expensive mistake.
It would. I can tell you with certainty that any kind of time period when you get to 10 years or longer, it was a mistake, because what we know about cash is cash generates a return that pretty much tracks the inflation rate. It not exactly, it might move 0.5% up or down from the inflation rate, but the interest that we earn is absolutely a function of inflation. I mean, again, when inflation's rising, guess what? Interest rates rise, and so the two go hand in glove. And so what happens then is, if you've got retirement money, the interest that you're earning, let's say inside your living annuity, might not be attracting tax, but when you draw the money out, you're paying tax there. And then, if you are a retired person and you're sitting with extra cash in a bank account, safe and predictable, well, that's definitely attracting tax on the interest. Yes, you'll get some interest exemptions, but you can't afford to give away 10 or 15% of the interest that you're earning to tax, because then you're absolutely certain of going backwards against inflation. So it's tragic advice, Bruce. I mean, I think, as I said, I guess I'm slightly exaggerating, but it should be pretty close to criminal. So I think for me, one thing is, don't de-risk yourself. You have to zoom out a little bit and say, retirement in retirement, it's a big event in your life. It's a big event in terms of, finding a different purpose, a different productive use of your time. But from an investment point of view, it's simply a transition from a point where you're adding to your savings, and now you're going to use your savings to fund your lifestyle. But you still have decades of investments, and potentially you go from being a salary earner or an entrepreneur to now being a professional investor. Because let's face it, if you're retired and you're living off your capital, what you are is a professional investor. And that requires you to have a decades-long time horizon. Yes, somewhat of an iron constitution when the markets are going crazy and headlines are blaring at you that the world's going to end again for about the 100th time this year. And all of that you've got to ignore to some extent and say, my biggest concern is inflation. I'm not worried about markets going up or down. If I'm sensible and kind of calm with the way I allocate my money, what I'm really worried about, and it doesn't come in a headline, is the buying power of my money being protected.
Is this true for everybody, Warren? Because if you've got, a nest egg of 50 million rands worth of shares, I get that. Where the markets go down and you have 40 or 30 doesn't really, it's upsetting. Very upsetting, I'm sure. But it doesn't mean that you starve. It just means that, you feel a little bit more vulnerable. But if you've got R1 million put away for the next 30 years, and your money goes from R1 million down to 60 or 70 or 600 or 700,000 rand, you're going to feel considerably more vulnerable, perhaps. And I wonder if there is ever a case where you secure your income if your amount of investable money is smaller than if it is larger.
Yeah, it's a good and trick question. So the answer is yes. There is a case for de-risking your portfolio almost in its entirety, and that's people that are in retirement with insufficient money, that it doesn't matter how they got there, whether it's the first day of retirement or the 10th year. If you're in a position where you're drawing more from your money than you can get growth to cover your expenses, then you have to de-risk your investments nearly completely. And so just explain that. If let's say you've got R1 million, and you're drawing 100,000 rand a year from your R1 million, that means you're drawing 10% a year from your investments. Unfortunately, the 100% of R1 million invested in the stock market, if you're just going to get what stock markets give you as an average, you might get around 10 or 11% a year, over a decade or two. But there are times when the stock market falls apart, and then suddenly you're in a position where, as you say, using your example, you've now got 700,000 rand and you're drawing 100,000 a year, and that's a completely unsustainable position. So if you are already in that position where you're drawing, and I think it's around about somewhere around 8 to 10% or more. From your total investment assets, you need to de-risk, and what you need to understand there is you're in a position of making the least bad decision you can. I'm not saying it as a critique. You're only faced with bad choices now. The one is protect yourself against inflation, which is why you need growth assets. But the other is protect yourself from a position where you actually draw so much because of a stock market downturn that you destroy the buying power of your money in its entirety in a very short space of time. And so, if you're faced with that, then absolutely, Bruce, then you say, well, now I try and find the very best interest rate I can. If I can lock in, around about 8 or 9% a year in interest, I'm not sure where you get that other than RSA retail bonds. Then I'm going to do that and do the best I can for as long as I can. And that means managing costs and the like.
Susan has sent us an email saying, I'm retiring soon and will be taking the 500,000 rand tax-free cash lump sum from my retirement fund. Now, that's what you can do from the age of 55. No matter how much money you've got invested, if you've got at least 500,000 rand, you can take it out tax-free. I'm unsure, says Susan, as to the best way to use the 500,000 rand. My retirement fund is the only real investment that will provide me with an income in retirement, and I don't have any other savings. Should I use the 500,000 rand to settle my outstanding debt or invest the 500,000 rand so at least I can have some funds available? Oh, Susan, good question. In a moment.
The Money Show.
Personal Finance with Warren Ingram.
So Susan is either approaching 55, is 55, or has passed the 55th birthday, at which point you can access 500,000 Rand of your retirement savings. You get them out tax-free, and you can do whatever you like with that money. You can blow it on a holiday. You can give it away to the cat's home. You can spend it on lottery tickets. You shouldn't do any of those things. What is best to do with that 500,000 Rand, Warren? Now, Susan's given us two specific scenarios: pay down debt or invest in something else. She only has a retirement fund, and so she's curious as to how she should best handle this cash that is going to become available to her.
It's a good balancing act to strike here, because the one thing about the 500,000 Rand is if you keep it as an emergency fund, for example, to cover the unforeseen expenses that you can't predict, it becomes a really valuable a financial planning tool. And also, if that's your only investment outside of your retirement fund, it's also what you would need to use, for example, to pay for big expenses, big lumpy expenses like, replacement cars and changing the roof on your house or whatever it is. So you want to try and retain as much of that 500,000 Rand as possible, and let it grow as much as it can, so that it becomes, a bigger part of your financial life. Unfortunately, if you're hitting retirement with debt, the thing to understand about that is that it's growing against you. It's compounding against you daily, weekly, monthly, yearly. And now, as interest rates are rising and we get to, prime interest, I think it's now, prime's at 9.75, that's nearly 10% a year that it's compounding against you. And there is no investment that's guaranteed to grow at a rate of 10% a year, tax free. So, my view is that I'm looking at that debt as a major red flag, and I'm wanting to settle that debt as much as possible, and if you can get it to zero with still having some kind of a lump sum left over, then that's what I would do, and then try and make a plan, Susan, to try and do something to build up your cash lump sum again. Whether it's from part-time work or doing something to get that lump sum a bit higher, to give yourself that protection against emergencies and other big lumpy expenses that are going to come in the months and years ahead.
Those dreadfully named tax-free savings accounts, the tax-free investment options that you've got, I'd love to see some of that money, if there is some left over, go into a tax-free savings account as the beginning of a process of allocating up to 36,000 Rand a year into that sort of environment, Warren. Yeah, sure, pay off the debt, but if there is a bit left, surely at any age a tax-free savings account makes sense, because you're going to try not to access that money for as long as possible, and hopefully it'll grow.
It's a good point. It's actually quite a debate in the industry, in the planning industry, because especially as you get over 55, then over 65, you start to be able to earn a fair amount of interest. Let's say for your emergency fund, you can earn quite a lot of interest before paying tax. So there is no real benefit there in putting the money into a tax-free savings. And similarly, you can earn 40,000 Rands worth of capital gains in a year without paying tax. So those two benefits would apply to any investment, whether it be interest bearing or just a normal unit trust or exchange traded fund. But certainly, if Susan is able to invest more than that, to get a bigger lump sum, then the tax free does make sense. I think it's as you said, it is one of the best investments we've got in South Africa, with certainly the worst name, I think. So I agree with you, and then go for capital growth in that, and let it grow as much as it possibly can.
And back to the first part of our conversation: don't be too conservative. Yeah, be cautious, but not conservative. Don't put it into an account. Put it into an investment. Subtle difference between the two. One draws an interest rate. One has the opportunity to draw dividends and capital growth. You're looking for underlying unit trust investments and buy shares and stuff.
Agreed. I mean, the one thing I will say is, definitely at retirement, you want an emergency fund that covers probably closer to 6 months worth of expenses. Normally, I would say 3 to 6 months, but when you're retired, aim for 6. That's a good use of having cash, and that is where cash is valuable. Everything else, go for growth.
Could you, if your pension fund is performing well, if it's a retirement annuity that's invested in a good balanced fund, you could just leave it there. And you could treat that as your emergency fund, couldn't you? Because you're not obliged to, on your 55th birthday, draw the money out. If suddenly at 58 or 59 or 60 you needed that 500,000 rand, you could draw it then, couldn't you?
Absolutely. And I think it's a brilliant idea, because the moment you draw the 500,000, it does start to become part of your own tax net. You might have to pay interest or capital gains tax, etc. So definitely, the longer you can leave it, the better.
Warren Ingram, personal financial advisor and executive director at Galileo Capital.